Hello and welcome. Happy Friday, everybody. We are the Real Estate Lab coming at you on this Friday, this lovely, cool Friday morning, which is awesome. Did you guys enjoy this weather this morning? Ian, behave. No. It's 70 degrees outside. That is a special
That's too cold. I didn't move here for 70 degrees.
We still have about 2 more weeks of summer, so I will take it. Today, I'm so excited because we're going to be giving a market update. It's no secret that Austin has had a wild and fun summer. It's been amazing, but what's going to happen next? So without further ado, let me introduce the rest of our crew. I am, of course, Liberty Walker, Realty Austin, and below me is the fabulous Adif with Adela Mortgage. He is here to be our expert in the interest rates to give us hands-on info about that. And what about this guy in the red shirt? Can you introduce yourself, Ian?
What guy in the red shirt? Oh, hey, everybody. I'm ianofAustin, everywhere on the internet. Pleasure to be here with you today.
And last but not least...
What's up, everybody? JJ Tolentino with the Next Level Property Group at Keller Williams Realty. Excited to talk about today's topic because people are wondering what's up with the market, and there's different elements involved in it, and mortgage rates are definitely one of those elements.
Yeah, it plays a really big part. I mean, the majority of the clients that I work with are going to use financing to purchase their home. And this last, year, really, interest rates have just been at an all-time low. And so the fear is, the questions that I'm hearing from buyers are, what happens when the rates rise? And sometimes I don't know what to tell them. So that's why we have Adif here today to really give us an idea. Like, what are some of the factors that make interest rates go up?
Hey guys, am I live?
Yeah, all live.
It is on and go. We actually had Connor make a comment too. What's up, Connor?
Hey, Connor.
That's for Ian.
He's
talking about Liberty.
Got it. Hey, I'm Adif. I'm with Adela Mortgage. I've been in real estate, 20 years or so now, I guess. Actually, I was a real estate appraiser before I got into the mortgage business back early 2001 is when I got in the mortgage business, and all in Austin. I went to school here at UT, got a degree in economics. I have a handful of personal real estate and a few other things. So
you've seen the changes that happen.
Yeah,
the ups
the market's
and downs.
been crazy, right? I mean, it's been absolutely nuts. I mean, the tallest building when I came here to go to school was the Chase Tower, and now you can't even see it basically. And the town's grown, but it's grown good. It's been great. And the market's been, I've gone through a couple up and down cycles, right? It's been, my first house was 8% something interest rate. And
wow.
So I've had a house at 8.5%. I've had a house at, 6% pre-crash 2008. Rates were 6.25%, right? And then we've climbed down ever since. We've been in this luxurious 2s and 3s for a long run, right? And even if you just go back a couple of years to 2018, rates were like 4.5%, right? So we've been a benefit of some really low rates here for the last period of time.
So can we show people what that means, what rates mean? You mind if I pull that up, JJ?
Go for it.
So, because we have a lot of people that have never purchased a house, and so they don't know. They're like, rates this, rates. What does that mean? So, can you explain to somebody like what this chart is that they're looking at?
Yeah, I mean, generally, right? I mean, you're looking at this chart and you're talking about rates as they increase, as rates increase. How does your purchasing power go down, right? And this chart kind of just reflects as rates kick up at 0.25% increments, what your payments change, and so as a result, your purchasing power goes down, right? So at the 3.75, versus you basically lose 40,000 in purchasing power over a 1% span in interest rates, right? And so generally what you see is, for every 0.5% in interest rate increase, your payments are changing about $150, somewhere right in that range, right?
So,
maybe not
so
quite
your
that.
monthly payments, let me stop you
Yeah.
there just so I can make sure I understand.
Yeah.
Your monthly payments for every 0.5 point will
Mhm.
fluctuate roughly about
About 140.
150.
Yeah,
$140.
140, 150, right in there, 140, right in that range, right?
So that's like one steak dinner.
Yeah, every month. And
Every
then
month.
the next question is like, what is the actual rate today? Because I don't know if people know or if you can explain, but
Yeah.
it changes daily, right?
Yeah, so mortgage rates are based off mortgage bonds, right? So it's like a stock. Mortgage-backed securities are traded every single day, just like stocks are traded every day. And the movement of these bonds and the buying and selling of these bonds are all dictated by the market and what's happening in the economy and what the Fed's doing and what our monetary and fiscal policies. And so these things are traded every day and they bounce around like a stock in rates. The market buys and sells these bonds and then rates get pushed out that way. So currently we're in a little bit of a low spot. Rates are kind of sitting in this like 2.75, 2.875 range for loans that are 500 in Texas, 548,000 or below. These are called conforming loans. So they're in the high 2.7, 2.875 range. 30-year fixed mortgages, 15-year mortgages are about 0.5% below. So 2.3, 2.25 in that range. The jumbo market, which is rates above 548,000 borrowed, those rates are a little bit higher. They're generally running kind of 2.875 to about 3 in the low threes, basically, is where they're at right now. So, I mean, we've had rates up and down all year. We've been, for the most part, in the high twos, and we had a little blip for about a month earlier in the summer where we were kind of butting up against 3%, 3.125. But for the most part, we've been in the low two, in the high twos, basically.
Yeah. So I would just caution anyone who has not yet refinanced. What would your rule of thumb be for them if they have a rate that's higher than, let's say, 4.5%?
Well, certainly 4.5%. I would say, if you really have a rate even as high as maybe 3.875 and your outlook and your house is going to be at least, you plan on staying put in that house for at least 2 to 3 years, you'll want to look into refinancing for sure. If you're going to have a shorter term in your house, meaning that you might sell the house or sell the house within the next 2 years, you probably wouldn't need to refinance. If you're in the threes, in the high threes, certainly if you're in the high fours or mid fours, which very few people are, I think at least there's still a few, but not many. Most people have refinance. But I've got a lot of clients doing equity loans too, right? Because we've had this amazing run on equity on real estate. And so, it's hard to go buy or upgrade in this town. And so we've got a lot of clients doing refinances and pulling equity out at the same time. And still a little bit lower rate there. So there's some advantage there. Again, you got to plan on staying put. If you're going to sell your house within a year or two, the math won't work out in your favor.
I love that point that you made because with, the market and prices rising, if you purchased your home 2 years ago, you might be able to refinance, get cash out, and maybe do some upgrades to your own
do some
home
upgrades,
and use that equity to really help you kind of.
Yeah, 100%, right? I mean, I think that this house, I think at least the way we see it with our clients is that you sometimes forget that this is just about, for most people, the number one wealth building tool, right? That you have. And so I think that it's not only just pulling money out to get cash out, but it's also maybe you have a loan that you bought a house a year and a half ago and you only put 10% down and you have mortgage insurance and now the house is worth 10% or 15% more. Maybe it's refinancing and get rid of that mortgage insurance and lowering the rate, right? And then reallocating those dollars somewhere else where you can have some more financial success. Generally, any data you look at, you should be able to get on average, a better return than 3% in the markets over a long period of time, right? Over a 5 or 10 year period. So it's kind of, I think that financial planning is important too, even if you're not pulling equity out. I think those things are important as well.
And, we're cautioning people, or we're letting them know, like, go ahead and take advantage while the rates are low.
Yeah.
But can rates fluctuate every day, but are there like some standards set in place, some caps?
Yeah.
Or can we wake up tomorrow and it be 5%?
No, it's almost impossible for them to wake up and be 5%. I mean, right now we're going through a period where the federal government's balancing and buoying everything, right, and helping keep rates low intentionally. They're spending $140 billion a month on buying mortgage-backed securities and treasuries and different things like that to keep rates low, to kind of make sure we come out of this pandemic properly and things of that nature. So, but it's really, I think what's most important, it's not so much, I think maybe rates, it's really jobs, right? So jobs basically dictate the job growth, and the wage growth basically will dictate what someone can afford, right? Rates are going to go up and down, but there's too much. We've got a combination of too much money in the system over the last 6 months. We have the federal government still kind of pumping and helping the system, and they're going to taper that off. They're not going to just all of a sudden turn off the spigot. They're going to slow and ramp it down, but they're only going to do that as jobs keep on growing and our economy keeps strengthening. So it's kind of like this seesaw, right, that's happening. And so so the mechanisms that are kind of in place with that would just not allow rates to jump from 3% to 5% in a very short window, right? Outside of some kind of catastrophe or something that happened, but they just wouldn't jump that fast. They would a little more gradually move up. And you could see rates over the next couple of years maybe as high as maybe 3.5%. I just see them going above 3.5% over the next year to maybe year and a half, right? And so, if you look at, I think our bigger issue might be just that what are, the inventory situation that we're dealing with, right? I mean, I think that's where we start having a little bit of, basically house prices can keep going up to the point that people can afford them, right? And we've generally had, if you look at the last reading on wage income, that was 5 to 7%. We know a normal economy pre-COVID, 2% wage growth. We were running 7% on annualized basis right now. So, if someone makes 7% more or 5% more on a $100,000 salary, they're putting $150 a month more in their pocket. And if rates rise up another 0.5%, it's all neutral to them, right? There's no difference, right? Whether it was 2 or 3.5, it's the same number. So as long as you're having wage growth and the employment situation's good, we can withstand higher rates, and the consumer can continue to pay that.
Speaking of employment, Connor says, heard anything about Disney and Gerald? Georgetown's 20 minutes away. I don't know if I've heard a little bit about different studios.
It is. It's actually not that. It's actually not even that far.
Georgetown, yeah.
Georgetown's really large. I don't know if you know. It's like 30 minutes across.
Yes, it spans
depending on what direction. It's
Liberty
so far.
Hill
so
to Hutto.
Yeah, so it's like 10 minutes away.
I do think
from North Georgetown.
Yeah. We'll have to keep an eye out, Connor, for Disney and Gerald, but I haven't heard of that yet. I've heard of some pretty crazy
employment-wise, I've read the stories about Netflix, HBO. I mean, there's some stuff. I was gonna bring up a tidbit about J-Lo and Ben Affleck, but besides that, y'all,
yes,
Realtor. You could Google that later. I had a Realtor question for y'all.
Oh,
how much do you push your clients on? Hey, it's low interest rates. Regarding your buyer clients, pull the trigger. take advantage of it. And how much does that weigh up against this big increase in appreciation that we've seen in the Austin area?
Ian,
Lady Liberty?
Well, honestly, when I have buyer consults and I'm going through these things with buyers, all sorts of different aspects of their life are going to impact what their plan is, what their specific plan is. And so I would take like a lot of the pieces and put it together and kind of come up with a custom plan. Rates are not going to be the sole motivator. Like Adif said, income, jobs, job security. Are they going to be having a promotion soon? If not, if that's their salary, then we can make kind of like a stable plan on what to do. If their salary is not going to be increasing in the next foreseeable future, I'd say there is no better time than to try and purchase now, because prices will just keep going up. We've seen some things stay on the market, right, Ian? There is more inventory, but are prices going down? No, I don't think so. What do you think, Ian?
So I think we have to consider the life cycle of families or people that are, or even people in our, what do you call it? Like our age brackets, right? These life cycles, what happens is people that are planning to build families, they start relationships, they end up procreating. And then they're like, we should probably buy a house. Like that's the large majority of people. And whether it's before, it's either at like right after college or skip college and you do it early, doesn't matter. That's kind of like the life cycle. And I think I don't know the numbers. I'm going to say 70%. 70% of people are just going to buy a house because they want to buy a house, regardless of the timing of the interest rates. Right? I don't know if that's a high number or a low number, but people that want a house in 10 years, if they want a house, they want a house. If the interest rate is 20%, well, they want a house. The question is, can they afford the house? And that's the thing that changes over time. Right now, so many people can afford a house, set aside the erratic market. So if you forget about the fact that some people are tossing an extra $50,000 towards something or paying cash on a house that you're like, man, it's $300,000. This is my moment. Set aside that. If we weren't having that issue, if we go look a little further out, like in Gerald, for example, you could get a house with a fairly low interest rate where 3 years ago, 4 years ago, you may not have been able to afford a house at that same price.
And there's a lot of creative stuff that people can do. I mean, if people want to live in the center of the city, but they have, this budget of $300,000, maybe buy a home in Gerald, hold on to it, have it as an investment property, build some equity there, use that. I mean, there are a lot of creative things. Also, you have to think about like what you brought up, Ian, the family life cycle, schools start, private schools, where do people want to go? I mean, you kind of have to balance. It's like that balloon animal where you squeeze the head and the tail gets bigger. I love that visual.
I totally lean on interest rates. I think it's just so advantageous. I mean, we're talking about a steak dinner every month.
Yeah. Well, I mean, I think
that's like life.
I think to y'all's point that's interesting is that the biggest population group that are buying homes right now are the millennials, right? And then if you go back to when these people were born and look at the graph over like the 5-year period that these people were born, I mean, that trajectory every year after year for the 5-year window there is going up, right? And so those people are late bloomers. They're buying now. They were kind of not buying then. Now they're buying now. And so I think that housing's only going to go down. It's a supply demand issue, right? And so like the only way prices go down is if there's more buyers than sellers, right? And vice versa. So I think that I just don't see the trajectory of that changing, coupled with all the chain, it's not like we can build a bunch of new houses right away. We have this supply chain stuff that won't stabilize for a couple of years. So I think you're going to still see like heavy demand for housing, I think, moving forward from this short run.
I had a question for you.
I had a question.
You go first, JJ.
All right. I'm gonna test out your econ degree. I also got my economics degree at UT.
Beautiful.
So let's see how this liberal
Let's
arts college works
see if
here.
you learned something. Yeah.
Where do you see interest rates going in the next year or so?
I don't see rates going above, like, really in the next 12 months. I just don't see them going above, like, I think at the high end, maybe 3.25.
Wait, you can't ask it like that. That's not how we ask the question. The question is, if rates rise, will Austin fall?
I think the answer is no. I think let them rise, baby, because the jobs are here. People will be moving here, and you need a home. People need to live. Investors will buy them to rent out. So I think that we have a healthy market and will continue whether or not rates rise slightly, as it sounds like Adif is predicting.
Yeah. I mean, as long as job and wage growth is going up, right? And our normal is 2%, our GDP normal is 2%. We've threw in so much cash in the system this last year. I mean, we put $4 trillion of extra cash. The federal government did, right?
I was like, I didn't get $4 trillion in nothing.
Neither did I. But
I got a little piece.
We actually did, right? All of us probably had one of our better years, and so I think that money is just flowing in the system that allows all these prices to go up and people to buy houses and feel comfortable about their jobs, have extra cash to spend on stuff. And so I think, that and this wage growth and the economy going, we also have 10 million, 11 million jobs available, right? And people are not, that people have not taken. So there is no shortage of jobs, right?
I mean, everywhere, as I'm driving around, I'm saying, we're hiring. I get emails all day long, and it's exciting because the jobs are there, but why aren't people taking them?
The thing about those jobs, and this is my super short opinion, is those jobs that are being left on the table are not the ones that will help you purchase a home due to the wages. Right? Like they're lower paying jobs based on the median price point of homes.
And there's also some people like just not taking those jobs because there's a percentage concerned about COVID. They just don't want to go back to work because they're concerned about their health. And then there's so many people, which should be changing now, right? They've been on unemployment assistance. The government's been paying them for a lot of these people to just they're like, hey, why do I need to go back to work when I'm getting a check for what I was making or more from the federal government? But all that unemployment assistance just stopped last week. So we should start seeing a shift.
Yeah, it's brand new.
Yeah.
So JJ, how do you answer this question? If rates change, as a economy major, what are your thoughts?
It depends. I mean, I think there's a lot of different factors, right? Like Austin, I think we're all bullish on because of the jobs, and tech money that is solid money, y'all. Like, look at profitability from Google, Facebook. And what they sell is like air. Like they sell us to ourselves. It's the craziest thing. But Apple, Samsung, it's all there, right? I think what Adam said is right. Now, I know a lot of people that are tuning in knows that we're Austin specialists. I would say maybe in other cities or towns it could be very relevant. But I think it won't. It can touch Austin, but I'm pretty bullish on Austin, and also I'm naturally optimistic, so I could be wrong. But I think there's some goonsday things to consider, just to be a little paranoid and keep you on your toes. Like Austin, for instance, is one of the fastest builders as a city. When it comes to home building, we lead the nation. So once we can start building again, and if lumber prices go down, the builders are going to put all that inventory out there. And, I think forbearance could also take some attention away. Possibly, it's just some stuff to consider. There's a lot of concentration in Austin to try to take away from it. But those are things I think that are worth considering.
That's a lot to consider.
Yeah. So my question was, do you think this affects other towns, like a non-Austin
I mean, God, I have a lot of colleagues in a bunch of different cities throughout the country, and I meet with them twice a year in a big group, and we talk about like their markets, and just about every single market in the country is doing great, right?
Yeah.
Doing better, just about. And I think it's, yes, I think that the jobs that are service and hospitality industries, those guys have been suffering and so forth. But just about everything else has been on fire, right? And I think certainly there will be towns that I think our town's going to fare better than most when we do start slowing down a little bit. And I mean, things will slow down eventually, right? I mean, this kind of crazy pace, we can't continue at a 7% employment gain, wage growth every year when we're normally at 2%. But I think as the government steps out and all those things, will stabilize more and will continue. But I think across the country, I think mostly every market's doing pretty good and probably will continue. And as we slow down, it'll go kind of across the board. We might, just like in 08, right? We were the last market to really take it on the chin in any real fashion, if you would want to call it that even, right? I mean, like in Central Austin, nothing changed outside of East Austin, just because in East Austin you needed, construction dollars, and the construction banks shut down for a period of time back then. But other than that, right? And there's so much money in the system, right? I just feel like people's got the staying power. There's just a bunch of cash that's been just like, there's just so much money in the system that just the combination of it is going to give us a good run, I think, solid, I think, for another couple of years. So if you got clients not interested or like, it's a great time now, rates are great, but I think it's still going to be a great time 6 months from now, 2 months from now. I think the trajectory with everything in place here is still good for a while until we start seeing a different imbalance, which might not be for another couple of years.
Yeah, and I think the last crash, 08, it's a different correction because that was irresponsible lending. Like I feel like this money is really here, if I'm seeing it right, and the demand is really there, and there is a real shortage of housing. So
yeah, for sure.
That's where it's at.
Yeah.
Well, I love the overall message of hope at the very end of our podcast today, because that's what I needed. It has been a wacky summer, crazy awesome, but also buyers were beaten up. I mean, it was hard to get a home under contract. Now they can take a breath. They don't have to feel super freaked out that rates will rise 2%, 3% tomorrow. So I think that that's my takeaway from today's episode. What do you think, Ian? Any other messages out there for our closing thoughts?
Yeah, closing thoughts, 2 real short. I had a graphic up that says Austin at the beginning of this year was number 23 for most job growth in the United States. So I think that's a contributing factor, and I think it's only increased since then. The second, and that was from Wallet Hub. I don't know how official they are, but like NerdWallet and Wallet Hub. And then the second thing, I want to answer Connor's question. He says, are there any new hot neighborhoods popping up for new build opportunities with little to no wait lists? The answer is yes. If you're getting inventory homes, the answer is if you're trying to build from scratch, they can't guarantee times in a lot of cases because of the supply chain. But overall, I think we're moving in a direction where people are able to get houses and should take advantage of the low interest rates if they can.
Also, Connor, check out our August 27th podcast, Austin Neighborhoods to Watch, episode 50, because me and Ian talked about 2 neighborhoods.
That's true. Thank you.
There.
Well, thank you so much, guys, for tuning in. Adif, it was a pleasure.
Thanks for having me. Thanks for having me. It's awesome.
And Adif is helping people find out what their buying power is every single day. So don't hesitate to reach out to him. Any one of us can direct you over to him. So thank you for that. And have a great weekend. Get out there and see some homes. See you guys next Friday.
See some homes. I like that.